Hi, I'm Ty, coming to you from my garden here in Portland, Oregon, and today what I'm going to be talking about is what is a planning model. This is part of a larger set of videos I'm going to do about kind of the steps that we go through in our consulting firm to help companies put planning models together. But I wanted to start this kind of first video, I wanted to kick off just what do we mean with the term or the phrase planning model. So sometimes this is in companies, this is referred to as budgeting or forecasting, although those are technically different. Planning, budgeting, forecasting could be technically different kinds of documents and different kinds of ways of doing corporate analysis. For the companies we work with, we kind of mush them together, and in bringing them together, I prefer the term planning model. And what we find is for the small to mid-sized businesses we work with, the operators don't really care whether you're calling it a budget or a forecast or a planning model. They just want something that helps them with forward thinking in their business. And so, for me, the reason I like the term planning model is this important distinction that this is not an exercise. What we're doing is not just making predictions about the business future. It's not like forecasting the weather, for example, right? The implication when we use the phrase planning model is that, well, we're actually planning. So what is a planning model? Well, the term model, we're planning, and when I use the word model, what I'm referring to literally is an Excel spreadsheet. Well, it doesn't have to be Excel, but a spreadsheet, right? And so we're talking about a spreadsheet or a group of spreadsheets in a workbook. And when we line this out for clients, what we advise our clients to do is to have 12 months of operating history. So we've got at least 12 months in there of the prior actual results in the spreadsheet model. And then we have the next 12 months, which are forecasted out based on our plan, right? So the plan for the next 12 months is in this planning model. When we think about the format, how would this actually be formatted? We're going to have multiple components to this spreadsheet model, and that model is, like I mentioned before, it's going to have 12 months of prior historical results, and then it's going to have 12 months of future results or future planning in it, right? And so that's kind of, if you're looking from left to right, or you're kind of running across it kind of sideways, that's in your spreadsheet. That's what you have to envision, is that you've got a column for every month, and you've got historical months, and then you've got future months in the plan. If you're going from top to bottom, what we do is we break the model into multiple sections. So we'll have a section for key performance indicators, and that's what a lot of people, you hear people talk about, quote unquote, dashboards. Dashboards are one of those buzz terms. I don't particularly like using that phrase too much, but a lot of people talk about they want dashboards. That would be our equivalent of a dashboard, is that we've got a section of key performance indicators which are calculating relationships off of historical results. So we're looking at the relationships between different financial results and operating parameters of the business. And that's what you often hear called key performance indicators. And so that's going to be in the model. And then we're going to have a section that goes through income. It's like an income statement, but as you'll hear me talk about in future videos, when we do income, we focus on what's called EBITDA, earnings before interest, taxes, depreciation, amortization, and we do a statement that gets down to that EBITDA. But we essentially have an income statement, and the historical months should be exported right out of your accounting system, and then the future months would be in the same format as what would be in your accounting system, but they're not in your accounting system because they're the future, right? Finally, we're going to have a section on cash flow, because really from our perspective, that's what the whole model is driving toward, is helping the business leaders understand how their key performance indicators and their operating plans are leading toward cash flow, either cash in or cash out, or whatever that plan is ultimately leading towards, and tells them not only cash flow, but how much cash they are going to have in the balance to be able to work with to grow the business. Because that's usually what we're focusing on, is growth organizations and how much fuel, how much cash they have to grow. And so the whole purpose of this kind of planning is being able to plot that out and see what that cash is that's available for the growth of the business. Well, I'm going to be addressing in future videos here, in the next videos kind of in this series, the 5 steps that we would go through, or the 5 steps that we go through in terms of planning creating a planning model. So with that kind of background that I just gave in terms of what we mean by a planning model, what it is, the 5 steps we go through to create that would be to first, we scrub the accounting process. We scrub your accounting process and your financial statements, make sure your historical accounting is correct and up to date. The second thing we do is we identify relationships and we identify drivers in your business that are important to your business or important in your industry, and that's what you're commonly referring to as key performance indicators. So the second step for us is identifying the key performance indicators based on your historical results, calculating them out, seeing if we can see trends based on historical results. The third thing that we're going to do is then set targets, which is really just about taking those same KPIs and then asking the question, okay, if we know what our gross profit margin was from the last 12 months, if we know how many products we produced per month over the last 12 months, if we know how quickly we collected from customers, cash from customers over the last 12 months, what is our plan? What is our target? How many products do we want to produce each month over the next 12 months? How many products do we want to sell each month over the next 12 months? How quickly do we want to be collecting our cash from our receivables from our customers each month over the next 12 months, right? These are all different kinds of metrics in the business, and we're setting targets as to what we believe can be done and what we ultimately want to achieve, the plan, right? So we express the plan in terms of setting these KPI targets. And then the fourth thing that we do at that point is we then use the forecasted metrics to extrapolate out forecasted financial statements. So we say, okay, well, if we can forecast out how much product we're going to produce and how much product we're going to sell and how quickly we're going to collect cash from customers, and again, there's a lot more metrics than that. I'm just using those as an examples. But if I have got a plan that says that has those things in it, I can use those things then to extrapolate out what the financial statements would look like as a result of hitting those targets. So I can actually look at, well, what would my income statement down to EBITDA look like if I hit those targets? What would my balance sheet accounts, like accounts receivable, what would my payables, what would those things look like as a result of hitting those targets? And ultimately the question is then, what would cash flow look like as a result of hitting those targets over the next 12 months? And what would cash in the bank be if we hit those targets over the next 12 months, right? So that is our fourth step, is taking our target KPIs and turning them into financial statement results. And that leads us into the last and final step, which is doing a comparison, a plan to actual comparison, right? So we identified the key drivers and relationships in our business, and we called those key performance indicators. We then took our business plan and we expressed them in terms of target KPIs in the future. We then extrapolated that to what financial statements would look like. And now, after we actually have actual results for a month, we can go back and make a comparison. We can look at an actual financial statement for the month that was just closed and compare it to what the plan thought would happen. What did we plan to happen? What did we think would happen as a result of our plans? And we can see if that's true. We can see if the actual results match up with the plan, and we can make these plan to actual comparisons, and then we can learn something from the variances. And I think hopefully what you're kind of catching from this is that it's not a static process where we do each of these steps once a year and then we're done with this process at the end for that point and we can just let it go for the rest of the year, right? This is a dynamic process. So these steps that I'm describing are designed that you just keep repeating them month in and month out, right? So at the end of every month, you close your books, you compare to your plan, you learn something from that comparison, and then you redo the steps again. You go back and you consider, well, what did I not think about with my key performance indicators before? What kind of assumptions did I make that maybe weren't quite right? We reset our targets, we reforecast based on our new targets, and then we wait till the next month to test the whole thing all over again. All right, well, that's kind of a really brief overview of what we mean by a planning model and what our process is. And in the next videos, I'm going to talk about each of those elements in a little more detail. I'll see you guys in the next ones. Take care now. Bye.